What is the stock market? And why am I talking about such a basic concept? Well, that's because there's a lot of misinformation and a lot of people telling you things that simply are not true about the stock market. So I want to start from the beginning and help you better understand the stock market, especially for those who are looking to get into it for the first time. And here's what it is. The stock market is a place where buyers and sellers meet to exchange shares of a company. Now, a share of a company represents ownership in a company. Now, if you own one share of Apple, that's a very micro, fractional, almost immeasurable amount of ownership in the company. But the more shares that you own a company, the bigger owner that you become in that company. So the buyers are the people who are wanting to buy the stock and see it go up. The sellers are the people who are selling you the stock. So when you're buying a stock, you're not simply just buying it from a company or buying it from your brokerage. You're buying it from somebody who owns the shares currently and are selling it to you. So the buyer is buying the stock with the hope that it goes up, and the sellers are selling it to you, the shares, because they think it's going down, and both think that they are right in their own eyes. And that's the magic of the stock market, is that there will be winners and that there will be losers. And now the bid and the ask price is where the shares are traded at. So the bid price represents the highest price that a buyer is willing to buy the stock for. And the ask price is the lowest amount that a seller is willing to sell it for. Now, a transaction happens when the buyer is willing to buy it at the ask price, or the seller is willing to sell it at the bid price. And when that happens, you have a transaction. And so with the bid and the ask comes the risk and the reward. Now, if you don't manage the risk on a trade, nothing else matters. And the risk represents how much money that you can lose on a trade. The key to it is limiting how much money you can lose on the trade by the way in which you manage the trade. So if you buy a share of a company or a stock of a company at $10 a share, and the stock goes down to zero the next day because they declared bankruptcy, well, you just lost everything. You just lost the $10 per share. If the stock goes up to $30 a share the next day because they had a great earnings or some kind of new invention that nobody was expecting, and that stock goes from 10 to 30, then all of a sudden you've made 200% of a return on your trade. And that's where risk and reward are so intertwined with each other that you can't trade stocks successfully without respecting both areas of the trade. Now, if you're going to succeed on 50% of your trades, and if you do, that's really good. A lot of people don't do that. But if you can succeed 50% of the time, then you're going to want at least $2 of reward for every dollar that you lose in the stock market. So that in most basic terms, if you buy a stock at $10 a share and it goes down to $9 a share, you lost $1 per share. Now, what you want is that the next time you're successful in your trade, assuming a 50% winning percentage, the next time you're successful in the trade, you want to be able to make at least $2 a share on that trade. So in theory, you'd want it to go from $10 a share up to $12 a share. If you do that, you have a successful 2-to-1 ratio. Now, that's not the exact numbers to use every time. Sometimes it can be going from you bought a stock at $10 and it goes up to $10.50, and the next trade you bought a stock at $10 and it goes down to $9.75. You're still maintaining that 2-to-1 ratio, and that's what really matters the most. And so with risk and reward comes winners and losers. And there's always going to be more losers than winners in the stock market. That's just how it happens. What you want is to be on that side of the trade, and the only way you can do that is by, when you have a losing trade, not letting it run away from you. You can't afford to just never sell a stock, because if you don't, you're never going to win. It does not matter how much that you make on a single trade. If you don't consistently and regularly, from trade to trade to trade to trade, manage the risk, it only takes one bad trade to wipe out all of your success. So manage the risk. If you do that, then by managing the risk and becoming a winner in the stock market, you're going to reap profits. And let it be clear, you're going to have losing trades in the stock market. That just happens. I have them all the time. I have about a 58% win percentage on all my trades, and that's really great. I mean, that's what you want. Win about that much, or anything above 50 is great. Okay, but when you're consistently winning, the only way you can do that is by consistently managing the risk. And if you know that the stock is not working out the way that you intended, that's the time to get out of a trade. And if you don't do that, that's where you're risking blowing up your entire trading strategy, because it only takes one trade to really mess it up. So just to wrap it all up here, there's buyers and there's sellers. Buyers, offer to buy stocks at the bid. Sellers offer to sell it at the ask price. And then there's the risk, there's the reward. You have to manage the risk in order to profit from the reward. And then there's going to be winners and losers and profits and losses. Okay. At the end of the day, manage the risk. We all get into the stock market because we want to make money. And that's why I did it. That's why everybody else does it. They want to make money. But the only way you do that is by managing the risk. And if you manage the risk, everything else will take care of itself, including the profits. Thank you so much for watching this video. You can click like below or comment on the video to let me know what you think, as well as subscribing to the Share Planner YouTube channel to learn more about how to trade successfully in the stock market. And check out these 2 additional videos that I think you just might like as well.